All right, good morning, everyone. Welcome to the Neighborhood Ventures podcast. I'm your co-host, Kyle Macdonald, along with today our special guest and CEO of Neighborhood Ventures, Jamison Manwaring. Good to have
Kyle,
you today.
good morning.
Yeah,
Good to be here.
it's great to have you on this one today. Usually it's the IR team or the finance team, but we get to have you today to start off 2026.
A lot of stuff's happening right now, so
Yeah.
excited for the new year.
Yeah, it's a special privilege, and yeah, we're here at Neighborhood Ventures. We're excited for 2026. We had an excellent 2025 where we acquired 4 different assets across Arizona at great, 3 of them at significant discounts. Another trophy asset in Flagstaff, Arizona, and we're continuing to see opportunities in the multifamily market. And 2026 is showing a lot of great opportunities. And today we want to talk about some trends that we're seeing here in Phoenix, also some national trends that we feel like are providing some great key indicators towards the multifamily thesis and continuing to invest in multifamily. So let's go ahead and dive into it, huh? So first article we really want to talk about is Phoenix's 2026 housing market outlook. So this article talks specifically about how Phoenix has been entering really a new kind of stability when it comes to the housing market. So if you're an investor out there or you recently bought a home, you've probably heard in the last 18 to 24 months people saying, oh, it's a buyer's market. It's a buyer's market. And what this article really talks about is how, yes, it is a buyer's market, but that's not necessarily a bad thing. In fact, it's really we're really trending, and we have been trending more towards normalization, where buyers have more negotiating power per se that they didn't have really the previous 3 to 5 years. Jamison, what's kind of your first take on that?
Yeah, as we've followed the market in Phoenix since COVID, every year has been a new challenge, new restrictions, different things that are holding buyers back from getting back in the market. And 2026, in my opinion, is actually going to be the most boring year that we've had since COVID, since 2019, when it comes to housing, and specifically to housing in Phoenix.
Mm-hmm.
So the big trends right now are that buyers are able to negotiate. The sellers who are selling right now tend to need to sell, and so they're more open to negotiations. If folks don't need to sell, more of them are still staying kind of on the sidelines and figuring out ways to hold on to their house, maybe turn it into a rental or a short-term rental. So the folks that are selling, you tend to be able to negotiate with them. And interest rates are in a pretty decent spot.
Yeah.
They're not super low. You're probably somewhere in the 6.5 range, and so you have to factor that in. But historically, that's in a pretty good range. So I think 2026 is the year of boring when it comes to housing. It's going to kind of be like this for a little bit now that we have a new administration. They're a year in. We kind of understand where interest rates are. Inflation has gone away, which is what really drives interest rate policy. Inflation has come down below that 2%. It actually isn't below 2%, but it's close enough to 2% where the Fed is I think in 2026 going to be very accommodative to interest rates. We're going to have a new Fed president that's going to come in, and they're going to be pretty dovish, meaning they're going to be keeping interest rates low because that's what the new administration wants, and and the new administration's who appoints that person. So I think 2026 is the year of boring when it comes to housing.
Yeah, and that's really interesting. I was reading some stats in this article, and one that stood out a little bit was there's what's called the demand to supply index that these people have been tracking in the Cromford report, which we're reading from, where 100, so the number 100 represents balance, 110 signals a seller's market, below 90 leverage towards buyers, and the index right now sits around 80. And so a lot of forecasters here in Phoenix specifically are saying this really right now is the best buying opportunity that we've seen in years. Like you said, interest rates have come down a little bit, 6 to 6.5%. But demand. We're also not oversupplied either, right? I mean,
not maybe in the short term. So the real opportunity right now, where we are probably a bit oversupplied, new builds, they're sitting on the market for a while, and so new home builders, they need to move that inventory off. So they're offering really aggressive concessions to go buy a new build home. That's where the opportunity is. Those concessions they're buying interest rates down to the 3% range.
Yeah.
If you go buy one of their homes, and they're paying for that.
Yeah.
So if you can go buy a new build today, that's certainly an opportunity where they are oversupplied. But I think that's probably more in the short run. And in the long run here, we're going to continue to need additional housing because of the migration growth that's expected over the next 5 to 10 years in Phoenix.
Yeah, and on top of that, like we, especially for single family homes, like we do not have supply. Like this is nothing like 2008 per se, and even, Phoenix has traditionally been known as a boom or bust town. And I want to read a quote from Christine Mackey, who is the new CEO of GPEC. She talked about how this region, citing Phoenix, has reinvented itself. The old Phoenix is gone. The new one is just getting started. And that's with she's talking about how Phoenix is no longer a boom or bust housing story. It once was. Could you elaborate that, being an active investor here in Phoenix?
Yeah, it kind of goes back to what my prior point. I think that we're in a more normal market this year.
Yeah.
The size of Phoenix now, the pretty regular migration of people who are moving here is becoming a bit more predictable. And I think you're still going to see most people priced out of the housing market in 2026. Most young folks who are antsy to buy a home, get out of an apartment, are still not in a position to buy.
Yeah.
And so even though we may be undersupplied in some ways, the affordability issue for purchasing, I think, keeps a lot of buyers in multifamily, certainly for the next several years.
Yeah, and you can argue too, staving off this bust mentality for Phoenix. I mean, we've never seen economic growth in this region than we have the last 10 years, right? I mean, from TSMC to bioscience companies moving here, to advanced manufacturing moving here, VCs and new startups coming out of the universities and local scene here. I mean, this is a completely different economy than 2008.
Yeah, our economy's really shifted from, in the 80s and 90s, really, the boom or bust is really driven by construction, development. And now our economy has shifted away from a construction-driven economy to another word that starts with C, chips.
Yep.
Both Intel and TSMC are making huge investments here, bringing high-paying jobs here, and then all their suppliers and all the ecosystem around them as well. So I think you're seeing a more mature economy here than what drove some of the boomer bust of the past 50 years.
Great. Well, that's a great way to start off the first podcast of 2026, giving overall housing outlook of Phoenix. Let's transition a little bit to talking about more of a macro key indicator that has been a challenge here at Neighborhood Ventures that really any multifamily investor and operator is facing nationwide is concessions and what's going on with, especially in the Sunbelt markets with large oversupply, and how to stay competitive nationwide. And so let's go ahead and dive into this report. So diving into concessions and what's happening nationwide. So we looked into this report from RealPage that talked about how 16% of stabilized apartments nationwide offered concessions in November of 2025. So this is really the most recent data on concessions, which is very hard data to scoop together. So shout out to RealPage. And concession prevalence and depth were highest in Class A product, Class C product, while Class B remained comparatively less aggressive. And the South and the West Coast together pushed national averages higher, so being the markets that offered really the most concessions. And the markets that with the heaviest usage of concessions are ranking number 1, San Antonio, New Braunfels, Texas area, Austin, Texas to San Marcos, so really that triangle close to Dallas. The next, Denver, the Denver metro area. After that, Las Vegas metro area. Then Phoenix metro, Charlotte, and Dallas, Texas itself. And so each of these markets had a different range of how many, what percentage of the units were offering concessions, as well as what their average concession rate was for the rent. Jamison, what was kind of your main takeaway here?
Yeah, so let's just talk about kind of what's happening with concessions, what's driving this.
Yeah.
Like any active market in a capitalist, in our capitalist economy, there's competition between apartment buildings, between different operators who are trying to lease up those apartment buildings. When you're doing that lease up, you want to try to keep your asking rent steady. If, for example, you have a building that you're trying to get $2,000 a month rent,
Yeah.
you want to keep that $2,000 in place on the lease. So where most of the competition comes from is concessions, and the concessions are the incentives to get people to move in, and typically that is always going to be in place. Sometimes it's a couple of weeks, sometimes it's as much as a month. In a really hot and limited supply market, like when I moved to New York City, there's not very many apartments there. I got zero concession. I just started paying, $4,500 rent day one. So concessions are come into play when there's an oversupply and when there's competition from apartment buildings to get their units leased. And in these markets that you just identified, mostly in what we call the smiley face in the U.S., the Sun Belt. If you just take a smiley face from the on the map, it's all the states in the South, including Arizona.
Yeah.
And those are the markets that folks want to invest in. Those are the markets people have built apartments in. They're the markets that long term are having the growth and will continue to have the growth. And they're the markets that are the most competitive for lease up. So concessions are elevated. As to your point, 16% of these apartments are offering concessions. What you don't want to see, and what's a negative trend, is when someone has been there for a year and you have to give them a new concession to stay.
Yeah.
So that is something that we track, and it's fairly normal that when somebody moves in, they need to get a concession as you compete to bring that person in. If you have to give them another concession, another free month to stay a year later versus move out, that's certainly not a good thing.
Yeah.
We're not seeing that at our properties in Arizona.
Gotcha.
We are seeing aggressive concessions from some of the newer build properties that are leasing up. And aggressive is like 2 months free. That's a lot. 8 weeks free, which is, it's not quite 10% of a 12-month lease, or it's over 10% of a 12-month lease. I'm doing the math in my head, probably 12-15% of the total. That's a pretty aggressive concession.
Yeah.
For our properties, we are offering 1 month free as someone moves in, and then on the renewal, we don't offer a concession at all. We focus on really strong operations, good property management, very responsive property management, responsive maintenance, and our folks want to stay because you don't know what you're going to get when you move into a new building. And if they stay with us, they know they're going to get that high level of service. And I think if you do a good job there in today's market, at least in Phoenix, you don't have to give a concession at renewal. But the folks who are offering that, they're probably doing that because they're not offering really great service at the property level.
Yeah, that's a great point, Jamison, because from the investors or listeners out there are probably thinking, well, like what's stopping your tenants from, having a great year where they got concessions from us or from Neighborhood Ventures for a month, but then, they look at an adjacent property that's offering maybe 2 months of concessions or a month, similar concessions as you offered before. And I think if you're out there listening or you're an investor, you need to take into account the mental, stress of moving. I also think that we're seeing more and more people who are, like you said, from the operational level, if you can create great service, but also a great community around it, whether it's you're offering not only amenities, but I don't know, maybe there's something I'm missing there.
No,
like
that's
experiences on the property.
Right. But that's the choice a consumer, a renter has today.
Yeah.
Do I renew at my current property, or do I move to another property? I might get 2 months free.
Yeah.
And they're going to weigh the benefits of that versus the cost. Mm-hmm. It's always a hassle to move. There's no doubt about that.
Yeah.
If you're going to get 2 months free, it's obviously a nice incentive. And it really comes down to, and we find this in all of our rental surveys, it really comes down to, are they getting good service where they're at? Are they happy where they're at? Yeah. If they're happy where they're at, they'll say, you know what, grass isn't greener over there. It might be for 2 months, but then after that, what's happened? That's how you run the business today, and that's why we focus on that so much today.
Yeah, that's amazing. Thanks for that insight, Jameson. Let's go ahead and shift to the final article that we thought was really interesting to talk about for 2026 and some key indicators we see going forward. We read this article talking about rent control. So what are you seeing? Why is this kind of a more renewed topic?
Well, this is a great article because it's putting the real science behind what happens with rent control versus the rhetoric. The rhetoric that we're hearing from the new mayor in New York City is the government needs to control the amount that rent can go up or down, and that the government should have a heavy hand in that. And this comes down to local government. This is not a federal or even a state issue. It tends to be a city issue.
Yeah.
And that's what the governor in New York ran on, or the mayor in New York City ran on. And so it's really started this conversation across the board. And it's something that I think we're going to hear a lot about in 2026 is should there be more regulations around rents because folks are concerned about affordability for housing across the board. The reality is that it is not affordable to buy today than it used to be, but rent remains very affordable comparatively, and rents haven't gone up for several years. But let's dig into this. So, does rent control work? And what this article talks about in the Washington Post is the tale of two cities. Yeah. You have the twin cities of St. Paul and Minneapolis. Mm-hmm. Minneapolis does not have rent control, but St. Paul enacted very strict rent control a few years ago, saying that rents couldn't go up more than 3%. And what ended up happening is the building permits in St. Paul plummeted by 79% after the rent control came in. So what happened was all the builders who were planning to add new supply to the market said, we're not going to build anymore.
We can't make this pencil.
Investors do not like the idea of having restrictions on rent, even if it isn't a really burdensome restriction. They don't like the idea that we're taking something that's a free market and putting that restriction on it. They'd rather invest somewhere else. So that's what we saw in St. Paul is building permits plummeted. Meanwhile, Minneapolis, which is just over the river, mm-hmm. these are right next door to each other. Minneapolis has rents went up in St. Paul more than twice as much as Minneapolis, which doesn't have rent control over this period. And then the landlords in St. Paul took it to the max, the 3% max every year, regardless, as almost a price fixing, because everyone said we're taking it up 3%. Where Minneapolis had stayed as a market force and a market driver, and so rents didn't go up in Minneapolis. So it's really interesting to think about when you go to government policies.
Yeah.
I'm sure the folks in St. Paul had good intentions around rent control. They're trying to make it more affordable. But when you're in a capitalistic economy, it's better to have more supply to keep prices down. We've seen that in our markets and in the Sunbelt market the last 3 years. Rents haven't gone up at all because we've had a lot of great supply, and it's been a good thing. So rent control doesn't work if you're trying to keep rent affordable. It's never worked. And the other quote from this article that I've heard many times is, besides bombing a country, the best way to make a city a third world city is to add rent control to it.
Wow.
So, and you've seen this across the board. Yeah. So we as folks who really look at the data, who look at this, and objectively, we need to continue to talk about how there are much better ways to solve the affordability issues that are going to be facing us than add rent control on top of it.